It's funny. Yesterday, I was showing you a video where I said, don't pay this tax. And I kind of went down a rabbit hole. We were looking at earnings growth year over the last 5 years. We looked at the Vanguard Growth VUG versus the Vanguard Value VTV. And it was interesting because the growth is averaging like earnings growth year over year, like 15%. And the value is only averaging 4.5%. All right. So I find that interesting. Growth is up significantly over value over the last 5 years too, and I would say 100% the reason for that is because of earnings growth. The earnings growth on growth stocks has dwarfed that of the earnings growth of value stocks. Now both are growing earnings, don't get me wrong, but I find that interesting. Now that is a hindsight. So earnings growth year over year is the backwards looking. We don't know what it's going to be forwards looking. All right. Now, we do know the PE ratios on growth stocks are much higher than the PE ratios on value stocks by a factor of about 2 to 1. We know the price to book on growth stocks is much higher than the price to books on value stocks by a factor of about 2.5 to 3 to 1. We know the dividend yields on value stocks are much higher than the dividend yields on growth stocks by a factor of about 2 to 1. And that inherently makes sense. You have good earnings growth year over year. People are going to go where the earnings are. That's the nature of the beast. That's the nature of the beast. And the earnings growth has led to higher PE ratios and higher stock valuations. Thus, the price has gone up, and the earnings are still, while the earnings are still, I think, quite favorable, relatively speaking, where alternatives are, real estate and bonds. There's the PE ratios are higher than the market as a whole, and certainly than value stocks. So anyway, I want to share this article, or not article, but this is from James Grant, The Forgotten Depression, the 1921, the crash that cured itself. I thought I heard Pablo. So here we go. This is page 162. Cheap stocks and bear markets always go begging. A Wall Street Journal editorialist in March 1921 observed. Investors don't want them and never have. If it were otherwise, there would be an active market today with an interested and even excited public. But the public was obviously unexcited. In the first 3 months of the year, in 1921, the New York Stock Exchange trading volume had barely reached 44 million shares, which is down 38% from the same it was a year previous. Did it matter that shares in the Steel Corporation were quoted at 1/3 of book value and at 4 times trailing net earnings, or that they were priced to deliver a dividend yield of 6%? Isn't that interesting? The United States Steel Corporation had a PE ratio of 4 times trailing net earnings, a price to book of 0.33, with a dividend yield of 6. Isn't that nuts? And if we go back a page, lacking the scale and financial strength of U.S. Steels, the independent steeling concerns suffered deep losses. From November 3rd, 1919, market peak, to the immediate aftermath of the Gary Price announcement, who was basically the CEO of U.S. Steel, on April 31st, 1921, Bethlehem Steel share price was cut in half. Crucible Steels was down 66%, and Republic Iron and Steel Companies was lower by 56.2%. In comparison, the Steel Corporation share price suffered a mere flesh wound of 27%, whereas the Dow Jones was down 37.3%. Now listen to this. This is of interest. Are you ready? At the low ebb in the stock market in the third week of August 1921, Wall Street paused to marvel at the resilience of U.S. Steel Corporation's share price. At 73 3/4, it had fallen by 34% from November 1919 to August 1921, compared to 46% loss in the Dow and declines of 57 and 68% of Bethlehem Steel and Republic Steel. Crucible was down 79.6%. But the CEO, a guy named Judge Gary, had earned his success. In the boom, the Steel Corporation had the foresight to lay in a $95 million inventory reserve. It was clear to the front office that the ruling inflated values would sooner or later come back to earth. That's the fact is, said the Wall Street Journal, that notwithstanding what the speculator may think about Steel Common. The investor regards a corporation as a country's strongest industrial concern and feels little doubt about the safety of its dividend. That confidence proved well placed. Did you hear that? They had the foresight to lay in a $95 million inventory because it was clear that the inflated prices would go back to earth at some point. I find that incredibly interesting. I want to show you another line here if I can find it. I might not be able to find it. Let's see. Yes, right here. Was the stock market too high? And this is in 1919. Remember that 1919 is the beginning, is the high end of the market. Hold on just a second. So 1919 was the high end of the market. 1921 was the low end. So the Wall Street Journal is talking about 1921 that cheap stocks go begging. There would be an active market today with an interested and exciting public if it were otherwise. Cheap stocks go begging. There was no one there to buy. However, 18 months previously, the Federal Reserve of New York declared, on the whole, this is on November 1st, 1919, the market seems to have moved according to the rules of speculation rather than that of investment. Purchasers appear to have been guided by matters of expectations rather than by performance in the way of earnings and dividends. Interesting. I mean, so much you can take from this, man. So much you can take from that. I guess got tons of highlights in this book. It's a great book. Get the book. It's fantastic. I did not know about Harding. I knew about Wilson being the freaking fascist he was, a leftist fascist. I did not know the benefits of Harding. But anyway, it's a great book. But anyway, so the issue is cheap stocks always go begging. So value stocks are cheap relative to their growth. Opponents? I don't even know if you call it opponents. I don't know what that means. But value stocks are cheap. Growth are expensive. And we've seen things like this a million times this Sunday where growth at some point goes down. But the thing is, we don't have nosebleed price earnings ratios on growth stocks. We just don't. We don't have value stocks trading at 4 with a price to book at a third. We don't. And we don't have dividend yields at 6. But at the end of the day, the facts are value stocks are underwhelming to growth stocks. And the reason for that is because the earnings growth of growth stocks has been through the roof, and yet the PE is significantly higher. I don't know what to make of that. I find that incredibly interesting. I bet if you looked, you could just see a huge correlation between stocks of growth over the last 10 years and their earnings relative to stocks of value and the earnings added to the dividend yields. I think it'd be interesting. I might do that actually. So, all right, just thought it'd be of interest. I'll put a link to the show notes if you want to buy it from my channel. I get paid big bucks. I think it costs $10. I get 4 something like that. I don't know, $18, something like that. I get a 4% commission. That'll make me rich. So, ready? Ooh, buy the book. Make Josh rich. All right, we'll see you.